The first thing most people would do if World War III started tomorrow is open their brokerage app, not call their family, not check the news properly, their brokerage app. Because that is what financial anxiety does to people. It takes every rational instinct and redirects it toward a portfolio that, in the grand scheme of a global conflict, does not need your help right now. And here is where it gets interesting. Because while you are doing that, while you are panic selling your index funds at 6 a.m. and congratulating yourself for being proactive, someone else is doing something that looks from the outside completely insane. They are buying. Not randomly, not recklessly, in a very specific order based on what actually happens to money during every major conflict this world has ever seen. What I am about to show you is going to feel wrong the entire time I am saying it. Because the history of war and money is one of the most counterintuitive stories in all of finance. And if you do not know it, the next crisis will cost you a fortune. Before we talk about a single investment, I need to introduce you to the people who are rooting hardest for you to make the wrong decision right now. They are not foreign governments. They are not hedge funds. They are the financial media. Every time geopolitical tension spikes, viewership goes up, ad revenue goes up, engagement goes up. The more scared you are, the longer you watch. The longer you watch, the more money they make. Your panic is literally their product. So when markets drop 2% on a war headline and the headline reads global markets in freefall, understand exactly what is happening. A 2% drop is a Tuesday. It gets called a freefall because freefall makes you click. Moderate pullback consistent with historical conflict patterns does not get the same ratings. Never has. Never will. The financial media does not just report on your fear. It manufactures urgency around it. It finds the most alarming expert available, gives them airtime, then cuts to a commercial for a brokerage platform that will happily process your panic-driven trades for a small fee. The news segment, the expert, the platform, the ad. Every single piece of that ecosystem profits from you doing the exact wrong thing at the exact wrong moment. Here is the data point that the financial media will never lead with, because it would immediately reduce your anxiety, and they cannot afford for you to be less anxious. Markets do not die in wars. They dip, they panic for a few weeks. And then almost without a single historical exception, across 110 years of data, they climb. The Dow gained 50% during World War II, 60% during the Korean War, 27% during Vietnam. The S&P 500 has delivered positive one-year returns after 73% of all armed conflicts since 1945. The stock market has survived 2 world wars, a nuclear standoff, a pandemic, multiple assassinations, and a debt ceiling crisis that nearly killed it without involving a single weapon. At this point, the market is basically a cockroach, and the suit it is wearing is doing fine. Here is why this is true. Wars are, economically speaking, the most aggressive government stimulus programs in human history. When a country goes to war, it spends without limit. Weapons, fuel, food, logistics, medical supplies, communications infrastructure, intelligence systems. All of it flows directly into publicly traded companies. The government becomes the largest customer in the world overnight, and it pays whatever the invoice says. That money has to go somewhere. And it goes into earnings. The investors who came out worst in every single conflict of the past century were not the ones who held. They were the ones who sold their broad market exposure to get to safety. And then watched the recovery from the sidelines in cash that was quietly losing purchasing power the entire time they waited to feel calm enough to get back in. JP Morgan tracked this precisely. A $10,000 investment held in the S&P 500 from 2005 through 2024 grew to $71,000 if left completely untouched. Miss the 10 best trading days in that stretch. 10 days out of roughly 5,000, and you end with 32,000. Miss 30 days and you are essentially at break-even for 20 years. 7 of the 10 best trading days in any given stretch happen within 2 weeks of the 10 worst days. The crash and the recovery are practically the same event. The financial media covers the crash breathlessly. They barely cover the recovery. Because a recovery is good news. And good news as a business model is basically worthless. Now, here is the exact order you move in. Each step creates the foundation for the next one. You cannot deploy capital intelligently if you are one emergency away from needing to liquidate everything. And you cannot hold a position through volatility if you are psychologically and financially overexposed. So we start at the base and build up. Step 1. Cash. 6 to 12 months of expenses. No more. Before a single dollar goes into any investment, you need 6 months of living expenses in a high-yield savings account or a government money market fund. And I know this is going to sound slightly dramatic. $2,000 to $5,000 in physical cash at your actual home. Here is why the physical part matters and why it is not as paranoid as it sounds. When Russia was cut from SWIFT in February 2022, Russian citizens woke up to non-functional ATMs. Not because their money was gone, because the digital infrastructure that moves it was switched off overnight. Cyber warfare is not theoretical. It is the documented first strike tool in every major modern conflict. And its most effective target is the payment infrastructure that lets you buy things. Physical cash for a few weeks of expenses is not prepping. It is a basic hedge against a 3-day banking disruption. Here is the critical part. This is where you stop with cash. Holding excess cash during wartime is one of the worst things you can do with money. Wars are inflationary. Wartime inflation averages 4.5% versus 3% in peacetime. Every dollar beyond your emergency buffer sitting in a savings account is slowly evaporating while real assets go up without you. Build the floor. Stop there. Move on. Step 2. Gold. 10 to 15% of your investable assets, but not for the reason you think. Here is the instinct most people have about gold during a crisis. Buy it now because the world is ending and gold survives everything. That instinct is right about the asset and catastrophically wrong about the timing. The people who bought gold at its January 1980 peak during the Soviet invasion of Afghanistan waited 26 years to break even in inflation-adjusted terms. 26 years. The people who bought at the 2011 debt ceiling peak lost 30% over the following 2 years. The pattern across every crisis in modern history is identical. Gold spikes on the fear, then gives back the fear premium once the worst-case scenario does not materialize. Gold is best bought before the crisis is on the front page. If you are reading a headline about gold hitting all-time highs, some of the move is already behind you. Right now, gold is holding strong, but for a different reason than fear. It is structural demand. Central banks went on an absolute buying spree starting in 2022, purchasing over 1,000 tons annually, the highest levels ever recorded. They are not panic buying. This is institutional repositioning by the people who manage sovereign wealth to diversify away from the dollar. When that is happening, the move is not over. The practical vehicle is EOW or SKOL, both holding physical gold at near zero cost. Keep a small slice, 5% of your gold allocation, in actual physical coins, not for the apocalypse, for the scenario where digital infrastructure is disrupted for 2 weeks and something tangible has immediate value. Step 3. Defense. 10 to 15%. This is the trade that wartime history hands investors every single time, and most people do not take it because it feels uncomfortable. Profiting from weapons manufacturing does not fit neatly into most people's self-image. The magnitude of the returns is embarrassing for everyone who did not own them. Raytheon gained 37% in the week after September 11. A $10,000 investment split across the top 5 defense contractors on September 18, 2001 was worth $97,000 by August 2021. Lockheed Martin has returned over 1,200% since the War on Terror began. In 2022, while the S&P lost 18%, defense stocks outperformed it by 28 percentage points. European defense stocks have surged 260% since February 2022. Right now, the defense sector is sitting on backlogs that would take years to work through, even if every conflict ended tomorrow. RTX has over $200 billion locked in orders. LMT over $160 billion. Poland is spending over 4% of GDP on defense. Germany approved a €100 billion special defense fund overnight in 2022. The EU as a bloc has shattered defense spending records every year since. This is not a war trade. It is a decade-long structural shift that war just accelerated. The cleanest ETF is SAR. Equal weighted, so you are not betting everything on 2 companies. It has returned over 20% annually for the past decade. ITA is more liquid, but top-heavy. ZAR gives you better diversification for the same exposure. Step 4. Energy. 10 to 15%. Ukraine sent Brent crude above $130. Anytime tension flares in the Middle East, we see pressure on the Strait of Hormuz, which carries 13 million barrels a day. The script never changes. Conflict restricts supply. Panic drives premiums. And energy stocks print cash. XLE at 9 basis points, concentrated in Exxon and Chevron, is the simplest vehicle. In 2022, when the S&P lost 18%, XLE gained 64%. That 82-point gap in a single year is the largest divergence between energy and the broad market in the ATF's history. Note what the financial media was covering in 2022 instead of telling you to buy XLE. The tech sell-off. NASDAQ in freefall. The end of the growth era. They were right about all of it. They just forgot to mention the thing that was quietly going up 64% in the same year. Step 5. Consumer staples. 10 to 15%. People do not stop buying Tide during a war. They cancel vacations. They skip restaurant reservations. They do not stop buying Tylenol, paper towels, and Coca-Cola. Because it turns out, humans require caffeine and clean surfaces regardless of geopolitical context. When the S&P was down 17% through August 2022, XLP, which holds Procter & Gamble, Costco, Coca-Cola, and Walmart, lost only 4%, 13 percentage points of cushion, 9 basis points of expense ratio, and a 2.5% dividend yield. It is the financial equivalent of a beige cardigan. Nobody is impressed. It will absolutely keep you warm. Step 6. Inflation protection. 5 to 10%. And a warning about the trap. Here is the most counterintuitive fact in this entire video. During World War II, U.S. government treasury bonds lost 67% of their real value. The classic safe haven, the thing every financial news anchor tells you to buy during uncertainty, was one of the worst trades of the entire war. Because wars are inflationary, governments borrow massively, issue enormous amounts of new debt, and inflate their obligations away over time. Standard treasuries get destroyed. What works instead is TIPS, Treasury Inflation Protected Securities, which adjust their principal automatically when inflation rises. The TEF version is TIP, or Series 1 savings bonds bought directly from treasurydirect.gov. 0 expense ratio, fully inflation adjusted. $10,000 per person per year. 1-year lockup. The lockup is annoying until you realize it is the government forcing you not to panic sell your own inflation hedge. Avoid TLT. Long-duration nominal treasuries are exactly what gets crushed when inflation runs hot and the government is issuing debt to fund a war. The financial media will not tell you this, partly because it is complicated, partly because their advertisers include the brokerages that profit from you trading in and out of bond funds. And the one thing you absolutely do not touch: your index funds, your VU, your VT, your SPY. Untouchable. SIFA Institute data across every major war found that large cap stocks returned 11.4% annually during wartime, higher than the 10% peacetime average. With lower volatility, the war economy is a stimulus economy. Government spending flows into earnings. Keep contributing automatically. If you have a Roth IRA, a downturn is the single best time to contribute. You are buying tax-free growth at a discount. The market goes down. You buy more. You do not look at it for 6 months. And you quietly thank yourself later. So here is what the complete structure looks like. 6 to 12 months of cash, including a small physical buffer. 10 to 15% in gold via YOW or SKOL. 10 to 15% in defense via ZAR. 10 to 15% in energy via XLI. 10 to 15% in consumer staples via XLP, 5 to 10% in inflation protection via TIP or Series 1 bonds, and the rest stays exactly where it already is in broad market index funds. The person without this structure on the morning everything breaks open will open their brokerage app. Sell everything. Feel briefly smart. Spend the next year watching the recovery from the sidelines while the financial channel that scared them into selling runs ads for the brokerage that processed the trade. The person with this structure checks what they already built, puts their phone down, and makes coffee. One of those people builds wealth during the crisis. The other funds the system that was designed to prevent them from doing so. The time to build the structure is right now, not when the missiles are flying. Now.